You really need to understand the value that you, coupled with whole life insurance, can bring to the table through infinite banking. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our EncycloMedia series, we're going to discuss human life value as it pertains to whole life insurance for the implementation of infinite banking. So this is a concept that I wished I had understood better earlier in my infinite banking journey. In the beginning, I was just looking to get out of debt and make positive money moves by buying policies that were structured for the implementation of infinite banking, as described in Nelson's book, Becoming Your Own Banker. Don't worry, just field testing a Viking battle axe for my son. And it's just comforting, you know, it's just good to have it in the office. Just good to have it in the office. So that was my number one priority. Was I saw a way to have a policy that we could use to get ourselves out of debt and to have guaranteed protection for my family. And I paid a significant premium in the beginning and got a significantly sized policy. But I did not maximize all of the insurance that would have been available to me at that time. Now, having implemented the concept for going on 10 years as of today, 2025, I have maximized my human life value, meaning that the insurance company has given me and I own multiple policies from multiple companies, but I cannot get more insurance today. Now, 5 months from now, 5 years from now, I may be able to get more policies. So that's always a moving target. So let me give you some specs on that. So one specification that matters when it comes to human life value, because everybody is only allowed so much insurance. One aspect is going to be age. What age are you at? See, in your 20s, you may be eligible for 30 times whatever your gross annual income is, let's say. And then in your 30s, you may be eligible for 30 to 25 times that amount. And then in your 40s, you may be eligible for 20 or 15 times. So you see that as you age, which is one factor, you're allowed a certain number of multiples. This is just a rule of thumb, a certain number of multiples of your gross annual income. So gross annual income is another metric that can come into play to evaluate someone's human life value. Now, it could also be net worth. So there are cases where you may have someone at an advanced stage with a relatively smaller annual income, but they might have a high net worth. And that may be the factor that we would base a policy application off of more strongly, is that high net worth. And then the reverse can also be true, that you could have a 20-year-old who has a relatively modest income, could be a high income, could be a low income, but you see what I'm saying. But they're eligible for a much greater multiple because of the time frame ahead of them, actuarially speaking, than say a 60-year-old or a 70-year-old. So the 20-year-old will be eligible for more multiples of their income, and they're more likely to have a smaller net worth. And it could be a combination. So for my last policy that I just got approved for and that is in force now, that has maximized my insurability as of this moment, I was able to use a factor of both my income and the net worth that I have to be able to qualify for that additional 7-figure coverage that I was able to get. So your age, net worth, typically speaking, and your annual income are going to be factors that will play into how much you're going to be eligible for. And again, that's just a good rule of thumb. 20s, 30x, 30-year-olds, 30x, maybe 25x. Your income is what you'll be eligible for in death benefit. If I haven't made that clear, that's what we're talking about, is how much death benefit, how much coverage, how much protection anyone is eligible for based on their human life value. 40-year-olds may be eligible for 15, 20x, 25x perhaps of their gross annual income. And then in your 50s, it might be 10x. In your 60s, it might be 5x, or your 70s might be 5x. So that's going to titrate up. And again, human life value just being an actuarial science that the insurance companies are looking at a large amount of people, saying, what is your anticipated, what is your expected value that you can bring financially speaking, because that's what insurance is, right? This is a coverage for a loss. If you graduate in your 20s, your family probably could have anticipated about 30 more years or so of whatever income you were earning. So do you follow that train of thought? I hope that that's helpful. If you have any questions about this particular concept, let me know down in the comment section below. Otherwise, I'm going to encourage you that if you're my client and we've not yet got to that point in our conversation, which I typically like to do sooner rather than later, in knowing what is available to you. How much insurance would you qualify for? And then, of course, have that conversation about how we could structure that for you to add another policy to your system of policies. Me and my wife, we own 7 policies as of this time. We've added those over the past several years to our system. We continue to add to our system. So we should have a conversation at least once a year on where you're at in your progress of infinite banking and building a system of policies and maximizing your human life value, pushing for that goal of income to equal premium like Nelson talks about in the book. These are all relevant topics that we should be having a conversation about. Otherwise, reach out to your financial professional. But you can find me at DurhamTalents.com. My hope is that you live and leave a lasting legacy. If you enjoyed this conversation, then make sure to check out this video where I talk about how my family used infinite banking to buy a car. Live and leave a lasting legacy.